All right, so today I wanted to make this video on a new series that I'm going to be doing. And again, this is on a Interactive Brokers paper trading account that I opened almost a month ago. And the reason that I opened this account is I had the mock portfolio going for almost a year now. And again, the reason that I changed is I didn't actually have somewhere where you could actually physically go and do things. And I wanted to do something to where you can more actively trade. Now, again, I'm never going to be a day trader or a short-term trader, but something that is actually realistic, because the problem with just having a portfolio on like Stock Unlock is technically there's nothing stopping me from saying, hey guys, turns out I actually put 50% of my money in NVIDIA 6 months ago or whenever it was. And now the $1 million is now $2 million or whatever you want to call it, right? This is realistic, right? So that's the first reason. And the second reason is I wanted an account to where you could use options and to where dividends are factored in, because the other problem too with just having an account on a website like a Stock Unlock is you're not really accounting for dividends, right? So that's another issue here. This, again, dividends are paid. So I wanted to get into what is the philosophy here. Again, if I was given $1 million a month ago, how would I manage it? How would I do that going forward? Now, again, the first thing to point out here is the market is clearly overvalued right now. And so again, when I get into this portfolio, what I did is I immediately put 3/4 of it into bonds. Now again, these are bond ETFs, USHY, SPHY. Those are both high yield bond funds. So again, we got about $500,000 in those. And the reason I chose those is those are currently yielding about 7.5%. And again, the philosophy behind that is, number one, if rates stay where they are, you're going to get that 7.5%. If rates go down, the value of these ETFs are going to go up. You can sell and invest into stocks. And if rates come down, chances are, well, most likely, if rates go down quickly, it's going to be because we had a major downturn, right? Something really bad happened that forced the Fed to cut quickly. Now, again, if we get some super slow, drawn-out process, either way, these funds, I think it's a no-brainer to have a decent percentage of your money in a fund like these, given the market is so overvalued. I still think that there's a lot of stocks out there that are not crazy overpriced right now, but again, this is $1 million. This isn't 10,000 or 20,000 or whatever the number that your average Joe is looking at investing. This is $1 million. So I think it's kind of stupid to pour the million in right off the bat. And again, that brings me to the other point that I brought up. I wanted to be able to use options in this account because options are a way to increase your returns on both sides. For example, number one, if you have a position, you can sell covered calls. That is a way to increase your income. The second reason is I wanted to be able to use options to enter positions. And this is the perfect example right now, in that you can sell put options, basically saying you take the SPY, right? The SPY is currently at, I think it's just over $500 a share. You could sell let's say a 450 put, saying, okay, well, yeah, the market's overvalued, but I would be okay buying in if it's corrected 5% or 10%. That's what I'm currently doing. And the benefit of that is, number one, you could buy the shares at a cheaper price. And number two, you can collect the option premium in the meantime, right? So this is a strategy that professionals typically use. And same thing goes on the other end. You can use covered calls to help bolster your returns. So that is the strategy here. And I'm going to be making videos on this more often because this is something that I check. Honestly, I check this almost every day. Now, again, I don't make a move every day. Maybe once or twice a week will something actually. The options are more common because I have some that are expiring pretty much every week, but the actual trades are not going to be as often because the vast majority of the companies of the ETFs and of the stocks that I'm going to be buying, I'm going to be buying using put options. And if the market doesn't come down, then I'm not going to end up buying anything. I'm not going to end up buying anything until the market comes down. And honestly, I think that this is the perfect way to manage money and to manage a portfolio like this because it gives you the best of both worlds. If the market continues to rip higher, okay, you just sit out in cash, get your 7-8%, whatever, 5-6-7%, wait for that pullback, collect your premium in the meantime. Like, honestly, when you include the option premium, I'm probably getting an extra % or 2, right? So if you're getting 7%, you're probably getting 8 or 9% with virtually no risk. So that is the strategy here. Again, I would love to hear other people's comments, critiques, and feedback there, but that is the strategy. Now, again, I do have some positions, but I don't have too many positions, right? Most of these are companies that or ETFs that I bought because I thought that they were not overvalued, right? I mean, Skyworks, I think, is definitely worth more than what it is. Paycom Software, I think, is worth more than what it is. QLYS, I think, is worth more. CEIX, again, I actually bought that at 81. It's currently at 92. Microchip Technology, again, I bought that at 80.84. It's currently at 88. EQ Bank, again, I still think is a buy where it's at right now. ARLP, again, a little bit of near-term headwinds there, but I still think it's a decent hold. URA, again, that's the uranium ETF. Again, that's corrected recently. I think that this is probably a good time to start taking a bite if you are interested. Copart, again, not a huge fan there necessarily. And again, another thing about this portfolio is I honestly plan on having probably like 50 different positions in here at some point. So every single position is like the most a position is going to be by the time it's all said and done. Give it a year or two, it's probably going to be like 3%, barring something running up massively. So every company in here I don't necessarily love, and it doesn't necessarily mean that I would hold it super long term. But most of the companies in here, I do plan on holding long term. So again, that is the strategy that I think is the best strategy for right now if you have massive amounts of money to deal with. If you're an average guy and you have $10,000 or $20,000 you're looking to invest, this probably isn't the way to go, because I think that this comes into play a lot more the more money you have, because the more money you have, I guess it's more of a diversification thing in that if you have $100,000 in total to invest, you don't want 10 or 20% of that to be in one company or one play. You want that to be diversified. This, again, is more or less, I want to take it very slow. I want to take it very slow because I think that there's going to be a correction at some point. And on top of that, if I can get 7 or 8% virtually guaranteed in the meantime, why would I not take that bet? And honestly, in my personal portfolio, I have started to do this to a degree. Honestly, SPHY is probably one of my top holdings right now, to be honest. It's definitely in my top 5 in my personal portfolio. I would have to double check and see where it is, but to be honest, I want to build that number up. I do want to build that number up because I think the market is clearly overvalued right now. I think that it's not a matter of if, it's a matter of when we get a pullback. And when that happens, if rates go down, not only do you get that capital gain on your high yield fund, you get to buy stocks at a discount. And you got paid 8% to do it in the meantime. Again, I also do hold BIL. This is a T-bill ETF that's yielding, I think, just over 5%. Again, that one, the value of it is not going to change, right? The value is between $91 and $92 a share, no matter what. These two, USHY and SPHY, these were the best quality corporate bond, high yield corporate bond funds that I could find. I didn't want to use ones that had leverage. I know there's ones that have leverage that have higher yields, but these were the best ones that didn't have leverage. And again, I think that if you can get 7%, that is virtually guaranteed. I don't know why you would pass that up. And again, it's not guaranteed long term, but for the next 6 months, yeah, I think it virtually is. Year, even possibly a year. So again, that is my philosophy on this. Like I said, I'm going to be making more. I'm going to probably update this at least once a month, maybe twice a month, just to see where things are at. And I think that this is going to be very interesting. This is very exciting. Honestly, I watch this pretty much as close as my actual portfolio because I find this very exciting and enticing. So anyway, that's what I wanted to bring up today. If you liked the video, please like and subscribe and stay tuned for more.